Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, coming to you live from Exchange in Miami. Joining me for this segment, we have Taylor Krystkowiak. He's Vice President and Investment Strategist at Themes ETFs. We are going to discuss providing access to innovative market opportunities in 2024 and beyond. Taylor, it's great to have you with us. Welcome to TradeTalks.
It's great to be here. Thank you for having me.
You got it. Let's talk about what are some of the areas that you think are ripe for disruption in the ETF industry?
Well, I think one of the big elephants in the room, and we've seen as a theme of this conference, have been fees. I think at the end of the day, all else being equal, greater fees going to have a greater drag on that investment performance, and whenever possible, wanting to target those segments of the market with the greatest potential for performance, while at the same time trying to optimize for the drag of fees on that overall total return.
Let's talk about distribution models for a moment here. You believe that traditional models are something of the past. How do you see them evolving?
Well, you know, we can see that across all industries, whether we take a page out of Tesla's playbook and we see that they consciously avoided a dealership model and going instead to direct to consumer. We know that distribution adds a considerable amount of overhead, which in our industry generally translates to higher fees. So one of the ways that we've certainly tried to provide value is trying to provide those savings to investors in the form of reducing our overhead distributional expenses and passing those savings on directly to investors.
Are there any downsides to direct to investor by removing any of those layers?
Well, as we've seen in the traditional distribution model, you have an opportunity to have more touch points, but one of the things that we've seen is that when we can really lean into innovative technologies like artificial intelligence, can actually help us cover the same amount of ground just as effectively as a multi-person team can. So really practicing what we preach, not only getting behind artificial intelligence as an investment opportunity, but also as a way to improve operational efficiency in the investment landscape here.
And you have an interesting talking point here. The future is below average. Okay, explain to me what you mean by that.
So, you know, when we take a look at kind of macroeconomics and where we go from here, obviously we're now testing all-time highs. We're really kind of in uncharted territory. The Fed has announced that perhaps they're done hiking and we are primed for a pivot, but at the end of the day, we are in a more normalized environment than we have been in those years past. And just mathematically, when we take a look at where valuations are and where the discount rate is, we might be going into an environment where perhaps we have lower returns than we have over the last 15 years. Those returns over the next 15 years may be inherently lower. And in that environment, fees are going to matter more. In a lower return environment, fees eat up more of a percentage and more of a share of your total return. So, you know, just mathematically, when we take a look at an environment that has 5% returns, a 1% fee over a 20-year time horizon, that's going to eat upwards of 30% of your total return. So almost a third of the investment exposure and gains that you would have otherwise had. So I think in this environment, fees are really going to matter a lot more than perhaps they have historically.
And when you think about the remainder of 2024, whether it's trends in the ETF space or even, you know, a higher level macro thesis, what are you going to be focusing on for the remainder of 2024?
So I think when we take a look at 2024, really targeted investment exposures are really going to make all the difference. Using a salient example over the last couple of weeks, we've seen that all banks, for example, are not created equal. So when we take a look at how regional banks in the wake of the NYCB news and earnings have fared, and going all the way back to the beginning of 2023, when we saw that regional banking crisis, Silicon Valley Bank went under, Signature Bank went under, First Republic Bank went under. Meanwhile, we've seen a growing amount of divergence between the big global banks, the global systemically important banks. So that's actually one of the investment exposures we've developed, one of the first of its kind. The ticker symbol is GSIB for those global systemically important banks. And we've seen a pretty wide performance differential between those names and the regional names. And that's a perfect example of, you know, just owning banks is not sufficient in this market. You really have to be smart about which banks you own, and we can see that sort of performance differential. Just to rattle off some stats over the last year, you know, we've seen those GSIB type banks performing upwards of 16% since the beginning of 2023 through today. Meanwhile, those regionals are down almost 8%. So, you know, being a pretty significant performance differential there, and how important that's going to be in the market environment going forward.
Taylor, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from Exchange. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.